All right, stocks continue their rebound over the last from yesterday. Continued that into today. A little slow, but kept it up and finished really strong by the end of the day today. Kind of this Santa Claus rally that you hear about a lot. So now the question is this like, is this a good like trend changing rally? Have we now kind of ended whatever little of a pullback that we've had, and a little more in the Russell, but definitely not very much of one in the S&P. Has that ended now? Is this period of weakness ended? Are we now leaning towards a new period of, this nice good trend to the upside? So we're going to break that down and see what the indicators kind of tell us and what we should expect. This is my last market outlook video of the calendar year. We do take the week between Christmas and New Year's off. We're not doing one on Friday. The market's closed on Friday, so just kind of a heads up there. The if things do get a little dicey, like obviously I'm not going to do one at all on Friday, but next week, if things get a little dicey at all in the markets, if there is a jump in volatility, if the market kind of goes nuts, then I'll get on and we'll talk about it, just to make sure we all know what we're doing and how to trade it and all of that. Assuming the market does what it always does between Christmas and New Year's for the most part, and just kind of does nothing, and we've kind of already saw that today with low range and low volume, then we're going to take next week off. I'll be with my families. You be with your friends and families as well. We're going to celebrate Christmas, have a great holiday season, travel, see fam, whatever it is that we all do. Enjoy that time off, and then we'll come back after the new year and get started again and kind of use this time to recharge our batteries. So assuming that's the case, that's what we're going to do. So I appreciate 2021. I appreciate everybody watching. That we get so many views in this video, well more than I would ever imagine that we would. So I appreciate everybody's participation and attendance and viewing over the last calendar year, and it's been a very interesting year from a market standpoint, and I think next year has a lot in store for it too. So if this ends up being our last video of the year, then thank you again for watching. Obviously there's more to watch, so stay tuned. I'm not ending the video right now, but if this is not the end, if things do get dicey, then we'll come back again next week. So with that said, let's get started on this one. Today is Wednesday, December the 22nd, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the Market Forecast Indicator. And nice, good rally today to kind of follow through on what we had yesterday. A little slow at the first, but it picked up at the end, and we closed at pretty much at the high of the day. In fact, I think we did almost literally at the high of the day there, just a point off. So that brought the near-term line all the way up to the 90th percentile. So very good, opportunity here. Now we got that over here too. Back exactly 2 weeks ago, we got the near-term line up here, and that didn't, and they actually brought the intermediate line out of bearish territory. And, eventually got into bullish levels, but we never did get above 80. We didn't follow through on that. So, kind of a 2-day rally and kind of finished it off with a small day, but then just sideways and nothing. So here we go again, 2-day rally, very similar. Are we going to be able to follow through on this? We're almost 1% above the moving average. Back there, we were just a little over 1% above the moving average. When you take a look at like the Russell 2000, you can see that its near-term line hit nearly the 100th percentile. It's got a very strong bearish posture to the downside there, below the 20th percentile. So it's still not quite there. Market sentiment's fallen below the 50th percentile now, so it's in the lower half of the chart. And you can see, remember the difference between the Russell and the S&P is the S&P is still on a bullish trend to the point where you're still getting bullish impulse moves. Like we have just retraced, we're just retracing this bullish intermediate run, but we never did break below the 78% level to get a bearish impulse move with bullish retracements. We're still in bullish impulse moves with bearish retracements. That's not the case in the Russell. The Russell, we had this intermediate rally, and we have broken below the 78th percentile. So this is a bearish impulse move. And so we're getting a bullish retracement now that that's up above the 23% level. Of course, you're going to have resistance here at the bottom of the Fibonacci retracement zone. Of course, your 30-day moving average is probably going to be there by the time we hit that, whether it's tomorrow or most likely after Christmas. I'm going to expect tomorrow's to be really, really quiet and light trading range. And of course, you'll have some resistance up there, and you won't get a bullish impulse move again until you break the 78 percentile, going in the opposite direction to the upside. So there's going to be a lot of resistance up here. Remember, the point of control is up there too on there. If you take a look at like the NASDAQ 100, which has been kind of doing something a little different, you notice it's not back above its 23% level. It is above its moving average, just barely, but not back up above that 23% level. Its near-term line did get to a really strong level, but its intermediate posture is actually still strongly bearish. So the intermediate line still down well below 50 and in bearish territory, just not in the lower reversal zone. The Dow kind of looks like the S&P, but its near-term line is not as it's not above this 23% line either. Its near-term line is not as bullish. It didn't get above 90. You are above the moving average there. But its intermediate line is still falling below its market sentiment line too, and we're 90% above. So, it's not like this 2-day rally has been a great rally, but it's definitely not a trend-changing rally yet in terms of a lot of these markets. Mainly just the S&P 500 right now is the main one that's really shown, because really it just didn't drop as much as the others. It didn't get below that 38% on this last pullback. If you notice, the NASDAQ on that last pullback did get below the 38% level, got down to the 50% retracement. And if you look at the Dow Jones, it also got below the 38% level. It actually got below the 50 and was flirting with the 62% retracement. So, much deeper declines, and the bounce backs hasn't been as strong as what we're seeing on the S&P. So that's why your S&P is back up above and pretty much, whatever, like the all-time closing high for the S&P 500. This is the all-time closing high. There's the all-time highest high, intraday high, but this is the all-time closing high at 47.12. We're at 46.96, so we're literally just about 15 points off of the all-time closing high. And you think, well, 15 points. Well, the range today was 52, so 15 points is literally nothing. So that's how close we are to all-time highs. Closing highs, mind you, on the S&P 500, when you have the Russell 2000, again, still below its 200-day moving average. In fact, it's incredibly rare that this is the first all-time high, new all-time high that the S&P 500 has gotten. New all-time high, because keep in mind all these others, where the Russell was below its 200-day moving average. So it's incredibly rare for that dichotomy to occur, where the large cap index is all-time highs, small cap index below that long-term moving average. And it's really below. It's not just somewhat below. It's actually really below that moving average there. Let's take a look at the long-term chart, the weekly chart. You can see we have a negative differential on the S&P. We've got a lot of neutral candles, so we're not really getting a trending candle one way or the other. We don't have a red arrow. The PPO is flat, so you have a really pretty neutral candle here for the S&P 500. The NASDAQ 100, you can see its PPO is falling. It's got more of a negative differential. It's gotten more negative this week, but still you got upper and lower shadows, so we're not really strongly trending one way or the other. And you do have a green arrow again, so you're not really bearish there. The Russell 2000, remember, the Hakkinashi close is actually below its 40-week for the third straight week. Yes, we're getting a little bit of an upper shadow, and we might get the actual close here actually is above the 40-week exponential moving average. But remember, the Hakkinashi close is a little bit more significant because it's an average of multiple prices. So you still have a negative differential, though it's a lot smaller than it was. It was the biggest over here. It's a lot smaller now, but the PPO is still falling. So we're not necessarily out of the woods yet here, and definitely not necessarily yet forming that transition candle where you get a really small body and a long upper and low. This is probably about as transition of a candle as we're getting so far. But this is usually your typical transition candle coming out of a bearish move where you got a very small body and a long and upper shadow about the same size. That's not the case this go around. So you can kind of get an idea of what, and let's look at the weekly market forecast here for the S&P 500, and you can see the bounce back. So we had this bearishness on the near-term line. It's gotten back up here, but it's still not, in the upper reversal zone. The near-term line is still not in the upper reversal zone. You can see intermediate line still up above 80. The NASDAQ 100, the intermediate line is not above 80 anymore. So, but in this near-term line bounce, but again, not to strong bullish levels. Your Russell 2000, the intermediate line is actually in bearish territory, heading for the reversal zone. That's why I think we're in a market sentiment decline, because you notice we don't typically get down here this low unless we are in an actual market sentiment decline. So that's why I don't think we're necessarily done with this. And its short-term sentiment's bouncing, but not strongly, definitely not to the upper reversal zone. You can see market sentiment line on the weekly chart is now below 80, which is unique because the S&P, you can see, is easily above 80. The Dow Jones is still easily above 80, and the NASDAQ is also still easily above 80. But the Russell obviously looks very bearish, and again, much more significant. And you actually have dark pink shading in a red line, which on a weekly chart is not too common. As you can see, it's the first time we've gotten it since the COVID low point. We briefly got it for a few times here in 2019, but again, there's your fourth quarter 2018 when the last kind of typical market sentiment decline that we got, that we could compare the kind of move we may be getting here from the Russell 2000 to in the past. If we look at the three green arrow charts, the three green arrow charts here, you can see we got one. We don't have pink shading anymore, but we don't have green shading either. Same thing on all the charts, really. They're all kind of clear. And that's okay. When you're bearish, you don't stay pink the whole time. In fact, it's actually pretty rare to stay pink when you're on a bearish trend. Let me show you. That was kind of unique because it was this COVID. But you can see it's pretty rare to stay pink for too long when you're bearish. And when you're bullish, you can be green for quite a long time and not get any pink at all. And when you do get a pink, it's usually just a one-day thing. But when you're bearish, you get more pink. You just don't get it all the time. And as of right now, that's kind of what we're seeing here on the Russell. We're back to clear, but we're definitely not to green yet. We have two green arrows on a lot of these indexes, but we don't have the three green arrows on any of them. On a lot of the S&P, you notice we are back above its moving the price itself is back above its moving average. You still just have a falling stochastic. It's probably the closest to getting three green arrows. Same thing with your diamonds. You are back above that 30 and 50-day moving average. Your NASDAQ 100, you're kind of flirting with that 30-day moving average. And your MACD down there, you can see is still negative. And of course, your IWM, you do have a green arrow on the MACD and the stochastics, but nowhere close to the 30-day. And again, very similar. I tweeted about this. We're above the 17-day, but there's a pretty decent gap here. So when you get above the 17-day, but not above both the 17 and the 30, then you basically just, at best, trade inside you fill the gap. You kind of need to break through multiple lines to feel really confident about a breakout and a change in directions. Otherwise, we might get a little bit of a bullish divergence up towards resistance and fill in the gap, and then get a new bearish divergence back to the downside. So as the MACD gets closer to zero, just work our way back down. So that's definitely something to keep an eye on, especially considering, unlike the last time we were above the 17-day, last time we were also above the 200, and last time the 30 was above the 50. This go around, we're well below the 200 and below the point of control. Last time we were above it, and the 30 now is below the 50. So we're in a much more bearish pattern now than we were even then. Just 2 weeks ago, last time we kind of flirted with a new bullish divergence on the MACD indicator here. If you look at the DMI for SPY, the positive indicator is back up above 25, but look, the negative indicator is still above 25 too. So, we're really not clearly turning bullish here. The Qs, the positive has turned. The negative indicator is below 25, but it's not below 20. So we're not breaking down there either. And then IWM, you can see the negative has dropped below 25 again, just like it did 2 weeks ago. And the positive is higher than it was 2 weeks ago, but it's still not above 20. So we still haven't ended this bearish run yet by getting these lines. So, last time we just got a new high point. on the negative indicator. So we need to see more than what we just seen the last 2 days to feel confident that this bearish run, this bearish impulse move is done on the Russell, and that we are now starting maybe a bullish reversal type pattern here. Let's take a look at the trend strength indicators. Still very noisy on SPY, but at least you're above the cloud, and at least you're above that green line. You're above the green and the blue line on the Qs, though the green is still below the blue, and you're above the cloud on the Qs. Still very noisy there. But if you look at IWM, we actually still have a pretty strong bearish trend. We're below the cloud. The price is well below where it was 26 days ago. We are above the green line, but not above the blue. So obviously that doesn't look so good, right, when you look at it from that perspective. And then finally, if you look at the Bollinger Bands, we are in the upper half of the Bollinger Band, with those still in that middle half there. Same thing with the Qs. Still, we are in the upper half, those still in the middle. But IWM, we are at the midpoint, and not really clearly breaking into the upper half here. We are out of the lowest quartile, but definitely not trending to the upside anytime soon here. And again, we did this a couple weeks ago, and we kind of failed there. So let's see if we don't fail this go around, we reverse this, then we'll feel much better about, again, at least a gap fill. Remember, up to that 50-day moving average or 30-day moving average, which is right around this area. So there's that breakaway gap that we had post Thanksgiving that never did fill on the Russell, and that still can act as, we're still not even to that resistance level yet, which is probably where that, I would venture to guess, that's where that 30-day moving average is going to end up being. Yeah, so there's the top, there's that gap, there's a top. So we'd have to get, the 50-day moving average is going to be, we'd have to get through there to start to fill in that gap. We have to get above basically all those moving averages, and the point of control, and a lot of that volume even above the point of control, to get through that spot. All right, let's take a look at today's intraday move. So we did get a higher high and a higher low. We closed at the high of the day. We closed above yesterday's high, so very bullish candle. There's the point of control for the 4 weeks, so that's kind of some resistance for us here. If you look at IWM, we are still in the lower half of the 4-week range. That's going to change here in a couple of days as these come off the table. There's that gap that we have to fill in up there. We did get a higher high and a higher low, though it's much smaller range. We did close above yesterday's high, but we didn't close above last week's high. SPY also did not close above last week's high, and the Qs is also not above last week's high, but again, above yesterday's high. So relatively bullish, though you can see not bullish enough to be bullish, right? Just bullish enough to not be as bearish, which I don't think that financial media really gets that distinction. We're either really bearish and we're falling off a cliff, or we're really bullish and the market's full steam ahead. Well, there's also different grades, and right now I think again that we're bullish enough to not be really bearish anymore, but we're not bullish enough to actually be kind of full steam ahead. We're just kind of in the middle, right? Waiting for either a new leg lower or a reversal, especially on IWM, a reversal to what would be a trend back to the upside. Lastly, let's take a look at the volatility index here, and you can see here's the thing that's concerning. As bearish as we are, right, with again the IWM below its 200-day moving average and things looking as bad as they are, the number of stocks below the 200-day moving average, here, where is it? Here we go. Let me see if this has been updated. Yeah, so it has not been updated yet for today, but we are below the mean of the last 2 years here of how many stocks are above their 200-day moving average, and yet volatility is already extremely low. And you look at the VIX here. If you look at the VIX, and let me look at the VIX on this chart, you can see that it's still not below its 200-day moving average. It got down to its 200-day moving average. If you come back over here, you can see last September and October, when we had that kind of quasi-intermediate decline, We got above the 200-day, and we really got back below it for good on October the 13th. Right there, we got below the 200 and the 50, and we pretty much stayed below it from then on. Okay, so obviously we're below the 50 and smidgen below the 200. But here's a big difference. Let's go to, remember, October the 13th. If you look at this chart right here, and let's go to the daily chart. Here was October the 13th. There's that day right there. So the VIX was barely getting below 20, almost the exact same level we are now, right? It was 1864 that day on October 13th. It's 1863 today. It's very, very similar. But look at down at the bottom. Over here, when we were at 1863, the VIX ratio was just dropping below the 90th percentile, was still, way up, at least it wasn't like high, but look at it now. Like, it's at extreme lows. Below 80% is an extreme low for volatility. So we didn't, after we dropped below this 20 and we dropped below that 200-day moving average, then we kept going down all the way down to 15. And on that move to 15, we got to these extreme lows. We're already at these extreme lows already. And we are just sitting on the 200, much less not being below. We're not necessarily below it. We were well below the 200 by the time we got down there. Now we're already down there, and we haven't broken the 200, and we're just barely breaking below 20. So in my opinion, I don't think VIX has a lot of room to go down because of how far down it already is. So what this means is that VIX 3M did not go down as much. It is still relatively high. Again, look at October the 13th. So here's where October the 13th was. We were at 2154 on that day. Again, the VIX was breaking the 200. We were coming off of this peak. Things were looking okay. We're at 23.5 today. So even though the VIX is at the exact same level as it was on the 13th, right there, the VIX 3M is not, and it's actually still higher, which means people are still concerned about a long decline. VIX 3M is 3 months versus 30 days on the VIX. So the market is still holding up here because they're still worried about a longer decline on a longer time frame of decline rather than just a short intermediate decline, which only typically lasts a month, right? Whereas it might last 1 to maybe 3 months or longer on a market sentiment type decline, which is what this would be trying to price in protection for. The VIX 3M. Look how fast the skew, which now is updated for today, look how fast the skew has gotten right back up to 142. Again, this is high. This is a high level. Let me just remind you of how high 142 is. 142, right where my cursor is. If you follow along to the left, these are really high levels. So this last year kind of moderates a little bit, but the reality is, if we were at 142 back in 2014-15, we'd be really scared. Like, the market would be scared about a big move to the downside, as we saw in 15 and 16, and then even going into 2018. And remember, the average is still at above 145, which it's incredibly rare for the average to get above 145. It did that right before the COVID drop. The market was anticipating. Not the COVID drop, the fourth quarter 2018 drop. The market was anticipating something to occur there. The market's been anticipating something like that to occur, and to me, it doesn't look like something like that has actually come out yet. So I think the market is still anticipating that, and that's why your VIX 3M is still as high as it is, and why volatility is still low, which means there's a good chance of volatility to probably bounce. Probably not tomorrow, probably not even next week. As things will be probably pretty light, barring any kind of new unexpected news coming out. But going into the new year, things might that volatility might be more suggestive of something happening then. So to summarize, obviously good bullish move the last couple of days. A couple of weeks ago, we saw a good bullish move over a couple of days too, very similar. But like I said, this go around, volatility might not be as good. So I don't know necessarily if this rally the last couple of days is trend changing, and I don't think it is. My expectation is, just like it was 2 weeks ago, it's an oversold technical bounce that gets us up to these better levels. Now the question is, where's the next where is this near-term peak going to end? Which I think will be, pretty soon. And then where's the next near-term decline going to be? And again, looking one more thing really quick that I didn't show. When you look at today's range and volume, the range was below average and the volume was well below average. That's not strong bullish bounce, right? That's not something that would change. That would be like, again, remember in bearish moves you get green bars. That's not a green bar that looks like we're ending this, right? With the volume and range, that would be like, this is it. That we ended that bearishness. It just looks like green bars in the middle of red ones. And we still got some more red ones left to go. So what do you think? Do you agree with that? Do you disagree with that? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that would suggest why you're either a lot more bullish than I am or a lot more bearish than I am? Post those in the comment section down below. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked the video today. Number two, you want us to do another video again tomorrow. Quick way to give us feedback if you like our stuff. Of course, if you don't like it, you don't have to click on anything. You don't even have to watch if you don't want to. Also, comment down there. What did you get out of the videos today? What stood out to you? What questions or comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us on our blog, come over here on the right, check out some of these other things that you have on the page here. Click on this icon, that takes you to our Market Outlook live page. You can also get to it by mousing over Market Outlook and clicking on Live Trade Review. This is where I post a live video every Monday, Wednesday, Friday at 3:30 Eastern Time. We review all the trades that we've done in prior Market Outlook videos to see whether we should stay in them or get out of them. We talk about that management. We also put on today's trade idea that you'll hear at the end of the video. We already put that on today during this live video before the market closed. So if that's interesting to you, check that out. Come down here, you can see our upcoming classes. Click on View More. That takes you to this page. You can also click on Trading Rooms to get you to the same spot. This is our upcoming calendar with all of our classes as well as all of our recordings that we've posted for 3 years back. You've got a lot of recordings there. Scroll down to the bottom, click on that heart. It opens up this tab, hit that like button. Also click this thumbs up icon, opens up this tab, hit that like button too. Again, the more you do that, it helps get our content out to all of our followers based on how this works. That's why we always ask for the likes. It really helps get our content out to everyone who wants to see our content. It also helps you because Twitter and Facebook promote content within your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here while you're watching. Alright, now let's take a look at what's driving the price action today. And you can see this is again from Friday of Thanksgiving. And you can see the rally we've had in small caps and commodities and emerging markets. That's the three-headed risk monster, right? That's our risk trade right there, at least as of right now. The Qs have kind of been a safety trade, but they kind of joined that risk-off move that we saw over the last little bit. They've been down too. Not as bad, all right? They held up better, but still. And they've really rallied here in the last couple of days to the upside, coming off of that Monday kind of mid-morning or early morning low point. I mean, we gapped down on Monday, but then we rallied the rest of the day. But you can see from that Friday, everything is still down. The dollar is actually down too. We'll take a look at that here in a second. But you notice that gold is up, bonds are up, real estate is up, long-term bonds, and they've been up the last couple of days too, interestingly enough. And you can see everything else all kind of, it's still a risk-off move. So now let's take a look at just last 2 days. All right, so this last 2 days that we've been pretty bullish, and you can see, okay, there's your three-headed monster: emerging markets, commodities, and IWM, QQQ, joining the party as well, rallying to the upside, bringing SPY up along with it. Gold, the dollar's been down, especially today, and that's why gold is up as much as it is. It's also why commodities are pretty strong. Bonds gapped down yesterday and have rallied up from there, and actually filled in the gap from yesterday by the close today. So a very interesting move from that perspective. Not necessarily kind of the risk-off move a completely risk on move that you see. Here's TLT, and look at the bounce back up. Again, we had gapped down yesterday, but from the open, we hit the 50-day moving average and then have rallied back up and pretty much almost got back above the 8-day moving average. Just like that, which means long-term bonds, which this is what it tracks. This is the 10-year yield. See the 30-year yield. If you look at the 10-year yield, the 10-year yield is kind of all, I mean, all these moving averages are pretty much all converged on each other. The 50 is still above the 200. The 30 is below the 50, but it's still above the 200. You know, we got above the 17-day yesterday, and we're, you know, it's just kind of neutral. Like all the moving averages are sitting right here in this range. That's the 10-year note. The 30-year is not. That's not the case. We're actually in this death cross environment. The 30 days below the 50 and the 200. The 50 is below the 200. We got up above the 30 yesterday, but now appear to be rolling back down. And again, this is more of a sign of this is very largely removed from Fed rate hike expectations. If you take a look here, if I go back, you can see the bear market that our economy was on from the fall of 2018. Globally, it started in the early 2018, but in the fall of 2018, that's where it started, and we were in a death cross environment there. If you take a look at the 10-year note, you'll see something similar. Right, we were in a death cross, but you see that, you know, we rallied off of that, but then we've kind of hit this peak, and we've been converging ever since. Well, that's not the case. We hit the peak in March and on the 10-year yield, but then the Delta variant hit in mid-March. The Omicron variant is hitting right now, and we're not just converging here. We're actually in a death cross. Like, we're back into this death cross like we were there. The 30-year note's probably telling us something that we're not seeing. And you know, again, that doesn't mean that the Fed's not going to raise rates, because if you look at Fed rate hike expectations here, and I tweeted this out yesterday, but the Fed rate hike expectations are above 50% for March. So, I mean, it was just a little bit ago, just a month ago, we only had about a 25% chance of a rate hike. It was very low odds. Just a week ago, we had only about 40% chance. So we've really changed to the point where now it's not just low probability, it's actually a coin flip. It's actually a little bit better odds of a coin flip. We are pretty likely that we're going to get one. In fact, in June, we're near 90%. By September, we're at 95, and then December, we're pretty much at 100. In fact, we were at 100 earlier yesterday when I tweeted out about this. There wasn't any 0 to 25 odds. It was all 25 to 50 or higher. So when you look at this and you say, okay, if I bring my little calculator over here, you know, we have a 98.9% chance of one hike. We have a 90.7% chance of two. We have a 67.6% chance for three. So high probability that we're going to get 3 hikes next year, and then a 35.7% chance for a fourth. And that's actually down a little bit because it was at about a 40 to 50% chance for a fourth, like I said, just a couple of days ago. So the odds for a rate hike have not changed. So the long-term yields are falling as economic growth expectations are not very strong, but the 2-year note yield is not falling because interest rate hike expectations are still very strong and they're not changing. So the Fed, we're in this conundrum right now where you know, in GDP expectations, and let's see, yeah, this won't be updated again until tomorrow, are still pretty strong, but starting to come down again. You can see that, you know, we had, you know, here's our GDP numbers for that first quarter of 2020. That's the COVID drop. And then, of course, the worst of COVID right there. You can see the bounce back we had in Q3. We've had some pretty good numbers for the next following year coming after that. So the likelihood of us being at, the likelihood of us being at 7%, you know, is very unlikely, right? I'm going to venture to guess that we're going to get just like all the rest of these all the rest of these quarters, here have all started off strong. Like this last quarter, we finished at 2%, but it started off up here too, and then gradually worked its way down to 2%. So there's a very good chance that that might still be the case for this by the time all is said and done. For this at least that's what the 10-year, that's what the 30-year note is telling us, and that's not a good necessarily a good thing to have, a divergence between falling long-term yields, which are economic growth minded, and rising short-term yields, which are a Fed rate hike minded. So you end up getting this you're about 67 basis points on the 2-year, and if you look at the 10-year, we were at 46 basis points. So that ends up being about 67. Let's see, 146 minus 0.67, less than 80 basis points of difference. They haven't even raised rates yet, and we're already to 80 basis points on this spread. Remember, when that spread gets to inverted, that's about as far as they can raise rates, and that's about as far as the economy can take, and that usually leads to a peak in the markets and a peak in economic activity as well. I mentioned the dollar not doing as well. Let me show you the comparison chart for the U.S. dollar and just look at today alone. Actually, we'll go back to the last couple of days. So we'll go to December, and then we'll go to the 21st here, and you can see that here's the dollar at 0. It's down against pretty much everybody, pretty significantly down against the pound, the Aussie, and the Kiwi. You can see the euro's up against the dollar. The Canadian dollar was, where's the Canadian dollar? It's this green one. It was actually pretty flat relative to the dollar going into today, but then it really took off today too. So, but it's it's still lagging behind some of these other commodity-based currencies. The franc's above us. The only thing that's not above, that did not outpace the dollar the last couple of days, by the time it's all said and done, was the Japanese yen. So very, very bearish move for the dollar here. And you can see what today looks like. The yen actually outperformed today. Everything was up against the dollar. So very, very bearish move on the dollar. If you take a look at like the euro US dollar currency pair here, we've been converging for so long. And then flirting with the 17 and back down, flirting with the 17 back down, flirting with the 17 this time, but crossing the 30 as well. So there's a good chance that we start to fill in some of this. And keep in mind that the dollar isn't a safety currency right now. Actually, the euro is the safety currency because that's the one that's been more oversold. So if the euro starts to rally and the dollar doesn't, that actually might not necessarily be a sign of risk appetite. It actually might be a sign of risk aversion. As you can see, this whole time, this whole year, the dollar's been, and pretty much since the beginning of the year, the dollar's been rallying while the stock market has been rallying, and not the other way around. So with the dollar now falling potentially, and you can see it against the CAD right here, with the dollar potentially now falling and reversing some of this, and there's a divergence showing up there with that clearly higher high, then that might be a sign that, okay, risk appetite, see how the dollar's been rallying against the CAD this whole time too. Risk appetite might finally be waning here, finally, at least in the currency market. One more thing, take a look at all the major markets on the 12 grid here, and you can see dark pink shading, red lines, light green shading on some of these, but still well below the moving averages in these developed markets. With all the COVID restrictions they have in place, not necessarily changing things around. A lot of these just look like very oversold technical bounces back to the mean. Now the question is, well, will we diverge from the mean in the other direction, or will we diverge from the mean coming back down in this direction? Of course, that's the million-dollar question, right? Finally, let's take a look at the sector on 12 grid and see how that's performing. And you can see, again, very good on XLK. XLY, XLC, not so good, and everything else still, it just looks like technical oversold bounces, and your safety trades end up still looking like the strongest performers. Again, if I were to look at the sector comparison chart, going back to that Halloween after the Friday, so the 26th, and we'll go keep it on the hour chart. You can see our safe havens have been doing very well, and they're holding their gains. XLK is really rallying. XLY and XLE have been rallying too because they were the biggest losers. So that's one of the main reasons why they've rallied so much financials and industrials to a lesser degree, and then XOK, of course, is its own animal. But when you look at that and you think, oh, well, there's a reason why they've been the best performers over the last couple of days, XLY and XLE, because they've been the biggest losers. It's essentially just been an oversold technical bounce with XOK, with a lot of the ARC innovation type trades within XOK kind of providing a lot of this lift too. When there's your financials and industrials outpacing a lot of these other safe haven trades, but they're all still up as well. So again, this rally doesn't appear to be like a trend changing rally. It just appears to be like a relief rally. But not, it's not a trend ending or a trend changing rally. It's just these were the biggest losers, and they're still losers. They're just not as, as if I go back to that November 26th, you notice they're still losers, right? They're still losers here. They're just not as much of a loser. But, it's just a little bit of a relief rally, and, the question is how much longer will that relief rally last before we get a new leg lower? Whether it's, again, tomorrow or next week, probably not, but going into the new year, are we going to get enough of a relief rally in the next week to change, or are we just going to kind of get nothing over the next week and then build up the momentum to build some volatility in that first week in January? That I actually lean more towards the latter scenario more so than the former. All right, so for our trade idea of the day, I wanted to take a look at Netflix. Netflix has been one of these stocks that has really come down. If you notice, from a Fibonacci retracement standpoint, let me remove that drawing and draw this on this current intermediate rally. You notice we got down to the 62% retracement and hit that for resistance, and then we got this great little bounce over the last couple of days that's got a pretty strong near-term line, higher than what we've seen on the last couple of near-term rallies. Getting up to the 90th percentile. Of course, nothing guarantees that will, that this will be the near-term leg that sparks a new intermediate run back to the green line, green territory. But it's a pretty decent sign. If you take a look at like the two-line version here on this chart, you can see we are getting potentially back above the 17. You can see we're not breaking above like multiple moving averages. But now you have an opportunity to kind of fill in some of this gap, maybe up towards the 38%. But you can see a low has clearly been developed, and we have the potential for a bullish divergence here on the MACD. If you take a look at the DMI here, you see that we are the negative indicator had been above 30 this whole time. It's not below 25 yet, but at least it's back down below 30. The positive is not back above 20 yet, but it's back above 15. Like we're headed in the right direction. If you take a look at the RSI and the CCI for Netflix, you can see that we're back above 0. We're close to the 50 mark, so we're back out of kind of bearish territory, back above 40 here at least. So at least we're not as bad, and you can see the divergence with the lower lows and the higher lows on a lot of these indicators here. So there's an opportunity that we might rally off of these lows. Whether we get to higher highs or not remains to be seen. Whether we get back above this 23% line is unlikely, remains to be seen, but at least we've kind of set a low. And so what I've decided to do here is trade a bull put spread, where I can sell that low 30s delta for 590, 585, sell the 590, buy the 585. You can see we already did this today in the Market Outlook Live video. We're down just a little bit since we got into it, maybe the spread. But you can see we're trying to go for a full position size and a $435 return. That break even is sitting right there, that blue line. So my break even is sitting right at support, right where we basically stopped. Of course, I've got a little wiggle room below that break even before, because I'm willing to lose $435, which right now is all the way down to there. So I've got some room to work with below that blue line. But I got some pretty decent support there with Fibonacci support, with the value area, with a little volume node as well, with the nice little bounce we've gotten off of the low. As long as we maintain that bounce and continue to push higher, it doesn't even have to really trend, just stay higher, then that's how we profit from a trade like this. Alright, you heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to other people's threads. And let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Subscribe to our website as well at marketscholars.com for free. Like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody. Remember, no market outlook on Friday. So have a great holiday season. Merry Christmas. Happy New Year to you all. And unless things go really crazy, we'll see you over this next week, which is doubtful. We'll see everybody in 2022. All right. Thanks, everyone.